One person cannot predict whether their house will burn, their car will be hit, or a medical emergency will happen this year. But across thousands or millions of people, patterns become easier to estimate. Risk pooling is the insurance idea that many people contribute money so the few who suffer covered losses can be paid. The pool works because not everyone claims at the same time. Most policyholders pay premiums during a year without having a major loss. Those payments help fund the claims of people who do. Next year, the roles may change. Insurance spreads uncertain losses across a larger group. A simple example is 10,000 drivers. Any one driver may or may not crash, but an insurer can estimate how many crashes may happen across the group based on past data, road conditions, vehicle types, driver history, and other factors. That estimate helps set premiums. Risk pooling does not mean everyone pays the same amount. People with different risk levels may be charged different premiums. A driver with repeated accidents may pay more than a careful driver. The pool still shares losses, but pricing tries to keep the pool fair and financially stable. Pooling works best when risks are independent enough. If one person has a kitchen fire, it does not mean every other policyholder has one that day. But if one flood damages an entire city, many claims can arrive together. Concentrated risk is harder for insurers to manage. This is why insurers care about diversification. They may cover homes in different areas, drivers with different profiles, or businesses in different industries. A pool made of risks that all fail together is fragile. A pool made of varied risks is more stable. Health insurance uses pooling too. Many healthy people pay premiums, while some people need expensive treatment. Over time, anyone can become the person who needs care. The ethical and economic idea is that health costs are easier to manage when they are shared across a group. The challenge in health insurance is that people know different things about their own health. If only people who expect high medical costs join the pool, premiums rise. When premiums rise, healthier people may leave. That can weaken the pool further, a problem often called adverse selection. Adverse selection is why insurance often has enrollment rules, waiting periods, group plans, or requirements to join during certain windows. These rules are not only bureaucracy. They help prevent people from waiting until a loss is likely before entering the pool. Deductibles also affect the pool. If every tiny loss became a claim, administrative costs would rise and premiums could become expensive. By asking policyholders to handle the first part of a loss, deductibles reserve the pool for larger covered events. Premiums have to cover more than claims. They also support administration, reserves, fraud control, taxes or fees, and profit or surplus depending on the insurer. If premiums are too low for the risks in the pool, the company may not have enough money when claims arrive. A good pool needs enough members. A tiny group is unstable because one large loss can overwhelm it. A bigger group usually creates smoother results. That is why scale matters in insurance. More data and more members can make losses easier to estimate and absorb. Reserves are part of responsible pooling. The insurer cannot spend all premiums immediately. It must keep money available for claims that have happened but are not fully paid, and for expected future obligations. Without reserves, the pool may look healthy until several large claims arrive. Reinsurance is pooling for insurance companies. If an insurer faces losses too large for its own pool, it may buy coverage from another insurer. This helps spread very large or unusual risks across even bigger financial groups. It is one reason insurers can cover major events. Risk pooling also explains why fraud hurts everyone. A false claim does not only affect the company. It pulls money from the pool and can push premiums upward for honest policyholders. The pool depends on trust, accurate claims, and rules that separate real losses from fake ones. Some people feel frustrated when they pay premiums and do not claim. But that is how the pool is supposed to work. A claim-free year means the person avoided a serious loss. The premium bought protection, not a refund guarantee. The value was having the pool available if needed. The same idea works in community life. Many people contribute to fire departments through taxes even if their own house never burns. The service must exist before the emergency happens. Insurance is similar. The shared support has to be funded before the loss arrives. A pool can become unfair if low-risk people consistently subsidize high-risk people without clear rules or social purpose. Some systems accept that trade-off for access and stability. Others price risk more individually. Different insurance markets draw that line in different places. For a customer, understanding risk pooling changes how premiums feel. You are not simply paying for your own future claim. You are joining a system that makes unpredictable losses manageable across many people. In return, if your loss happens, the pool is there for you. Risk pooling is the reason insurance can exist at all. One loss can ruin one household, but many households can prepare together. The system only works when the pool is broad enough, priced carefully, protected from abuse, and clear about which losses it promises to cover. Risk pooling is also why timing matters. If someone could buy coverage only after the accident, the pool would collapse. Premiums must be collected before losses are known. The agreement works because people join while the outcome is still uncertain, not after the bill has arrived. Group insurance often uses pooling strongly. Employees in one company may be covered together, mixing younger, older, healthier, and less healthy members. The group structure can make coverage easier to price and administer than separate policies for every individual. But a pool still needs rules about what counts as a covered loss. If every inconvenience becomes payable, the pool drains quickly. Clear definitions, deductibles, limits, and claim reviews protect the shared fund so it can pay for the losses it was designed to cover. The pool also depends on honest information. If many members hide risky facts, the insurer may underprice the pool and collect too little. Later, when claims arrive, premiums may jump for everyone. Accurate information keeps the shared fund closer to the risks it promised to carry. The final idea is simple. Risk pooling turns individual uncertainty into collective preparation. Nobody knows who will need help next, so many people prepare together. The promise is not that everyone will receive the same payout. The promise is that covered losses will not fall entirely on one person alone. This also explains why leaving a pool can affect more than one person. When many lower-risk members leave, the remaining group may become more expensive to cover. A healthy pool depends on enough people staying in before they know whether they will be lucky or unlucky that year. The strength comes from participation before certainty.